I'm not in the camp that earnings are going to trough this quarter on rate of change. So, the call was that a lot of people thought the first quarter was going to be a trough. Now it's second quarter. Our guess is probably third or fourth quarter. And we think the numbers are still coming down. So if you look at forward 12-month earnings for the S&P 500, the growth has gone from 22% to now about 3% on a forward 12-month basis. We think it will go negative in the next 2 quarters. It'll probably go 5% negative. So not a disaster, but that is an earnings recession. And look, I think that it's pretty clear what's going on this year. Economic growth is disappointed for the most part, not just globally, but also in the U.S. Leading indicators are softer. The earnings are coming in softer. While I respect some companies' margins are bottoming, I don't think that's true across the board, and that's been our main call for the last year. We still think there's margin pressure in the system. So the way we think it's going to play out is the Fed's on the ball. We don't think we need to have the kind of correction we had in December, because in December they were still tightening. But we think that 10% correction is very likely in the next 2 to 3 months. Once the earnings go negative on a year-over-year basis, that's when the market will care.
If you're right.
If I'm right. Right. And there's no reason to think that's not the case, because that trajectory has played out, Scott. I mean, if you go back a year ago, right, our call was wildly out of consensus. OK, it became more consensus in the first quarter. People kind of acknowledged it, and then they got off the train. And we're just not getting off the train. We think that the earnings risk is still significant. It's probably 5 to 10% downside in terms of the earnings, and that will be some multiple contraction in there. And that's it. That's the story. And then we can look forward. It's a 18-month kind of rolling bear market, cyclical, top at 3,000. This will be the third attempt. OK, if I'm wrong, we're going to break through 3,000 cleanly in the next 2 or 3 weeks. If I'm right, we're going to fail again. So we have a big event next week with the Fed. And if the market can't break out on that, I think that's a pretty good sign that I'm probably right about the earnings.
Coca-Cola CEO on the environment on CNBC earlier today, quote, "There were some dark clouds, but the storm never came." So why can't you take off the raincoat?
Okay, well, look, that's a consumer staple, right? We're overweight consumer staples. They tend to be a little bit more defensive.
Oh, they're a global company.
Let's talk about Arrow Electronics on the other side. Arrow Electronics says recession's here. Okay, and they are at the bleeding edge for semiconductor consumption and hardware consumption, which I would believe them a lot more than I would believe TSMC, who doesn't have end customer visibility the way Arrow does. And I can name a whole host of other companies that are saying the same thing. It's more mixed now, for sure. It's definitely more mixed in terms, because some companies have been revising earnings now for over 12 to 18 months. And so our call continues to be that all the risk is in 2 areas in the market now. It's in defensive areas, bond proxies, and it's in high quality. That includes growth, but it's really high quality. And we have a lot of names in there, right? Our fresh money buy list, our focus list has outperformed dramatically over the last 12 to 18 months by 1,200 basis points, okay? Because we've been focused on those areas. However, I'm getting nervous because those are the areas where the risk is the greatest. It's not in cyclicals. It's not in things that have already corrected. But that has to go, we have to go through the course of that. People are overpaying for that defensiveness, and I think that's where the risk is in the market.
Hey, Mike, Arrow's been getting a lot of play this week. People have been talking about it a lot. But how much of that is the inventory carry forward, or that demand carry forward in the advance of tariffs, things that were happening at the end of the fourth quarter into the first quarter because of China? I mean, couldn't that easily reverse? And also on that note, inventories, which are projected to be a drag going forward in the second half, if you continue these trade tensions, maybe they need to stay high as supply chains rework.
I think that's right. I think that there's a little bit of a misunderstanding about how much of the inventory build was tariff related and how much of that was built on double ordering because the economy was overheating last year. So, for example, in the semiconductor supply chain, we wrote about this a year ago, right? A lot of people built inventory because of the Apple product cycle, and they built too much. And then, of course, there's double ordering for data center, and that built a lot of supply in the supply chain for those 2 product cycles. In retail, it's the same thing. A lot of retailers saw a pickup in demand last year because of the tax cuts, and they thought that was going to continue, and they built way too much inventory. And, of course, in industrial, we know about that. I think in industrial, we're probably the furthest along with respect to the inventory getting set. I think in semiconductors and hardware, we're nowhere near where we need to be yet. And I think in retail, it's just starting. By the way, one last comment on that. The Amazon Prime Day went extremely well, okay? But remember, they just increased that by 12 hours on June 25th, right? They increased another 12 hours. And I have a view they did that because they were trying to burn through a lot of inventory. And by the way, they pulled forward a lot of demand by heavy discounting. People bought a lot of stuff. And I think we're going to have a bit of an air pocket on demand in the third and fourth quarter because of some of this pull forward.